South China Morning Post, 30th of September 2022, Bangladesh is increasing its yuan commerce, but its reliance on the U.S. currency drains its foreign reserves. Still, economists predict that Southern Asia will continue to rely heavily on the dollar. Bangladesh is increasing its use of the Chinese yuan as a substitute for the US dollar in international dealings. China would only be able to benefit modestly from this, while Bangladesh would not gain much. The authorized dealer AD banks, authorized to buy and sell foreign currencies, were permitted by Bangladesh's central bank earlier this month to settle trade agreements with China in the yuan. This goes beyond its decision in 2018 to let these local banks open yuan-denominated foreign currency clearance accounts with the central bank. Banks can now have yuan accounts with their corresponding branches abroad to settle international payments. This mistake will further deplete Bangladesh's already low foreign exchange reserves. Import costs have increased due to the coronavirus outbreak, Russia's invasion of Ukraine, and issues with debt servicing. The action coincides with several central banks raising their yuan reserves. In recognition of the yuan's internationalization, the International Monetary Fund, IMF, added the currency to a basket of special drawing rights, SDRs, in 2016. Additionally, in May, the IMF increased the weight of the yuan in the basket by 1.36 percentage points or 12.28%. However, the dollar's growth, which grew by 1.65 percentage points to make up 43.38% of the basket, overshadowed its growth. In the current five-currency basket, the yuan is ranked third by weight after the dollar and the euro but before the Japanese yen and the British pound. According to the 2022 UBS Annual Reserve Manager Survey, which surveyed 30 central banks, the average 10-year target allocation for the yuan as a share of global reserves is 5.8%. Compared to the 2.79% recorded by the IMF for the fourth quarter of last year, that would represent a significant gain. The proposal, according to analysts, would not benefit Bangladeshi traders and is more likely to do immediate economic harm to the nation. According to reports from the central bank, Bangladesh's foreign exchange reserves decreased from $48 billion in August 2021 to $36.8 billion as of September 22. The amount used to pay for the imports can roughly cover 4 months' worth. According to Chinese customs data, Bangladesh's exports to China from January to August totaled roughly $662 million. Still, its imports from China were worth $18 billion over the same period, or 27 times as much. Due to the enormous import and export market directly next door, adopting the Indian rupee would be more advantageous than concentrating on the Chinese yuan. Ahsan H. Mansoor, executive director at the Policy Research Institute, pointed out that Bangladeshi banks don't have a lot of yuan in reserve due to the country's small exports to China. About 1.4% of Bangladesh's $36.6 billion foreign reserves are made up of the yuan. Mansoor claimed, "We are unduly dependent on ready-made clothing and haven't developed other things in our exportables basket. The Chinese market is collapsing. Thus it might already be too late to realize China's enormous import potential." Individual traders are also unlikely to utilize the yuan to settle their business with China if they frequently import from China and India while exporting to sophisticated nations like the US, Europe, and Canada, said Hussain. "I don't see much potential even if dealers now can use payments. Politics more influences this choice than economics." He continued, "The fundamentals would have to be changed to relieve the strain on Bangladesh's reserves." Bangladesh will continue to have a surplus of demand for foreign currency as an import-dependent country. Still, the central bank has increased pressure on reserves by selling about $7.6 billion in the 2022 fiscal year to defend the value of its taka. Mansoor suggested that the central bank move decisively out of this policy of draining the reserves and focus on exploiting the Indian currency and the Indian market.